are you doing? Welcome to the August real estate market update. We're going to go over all the July stats. I've got Tyler Croft here, who is a lender with Croft & Co. Lending, and we're going to dive into the market stats. So let's go ahead and get that started so you can know the latest on what's been going on here in the Prescott area. All right, so we're diving into statistics straight out of the Prescott Area Association of Realtors database. So this is anything that has gone through a realtor in Prescott. If it was a for sale by owner or an off-market property, we probably don't have the stats in here. But yeah, so let's dive into this and I can show you what's been going on. So first of all, we're going to look at Prescott itself. As of last month, or as of the end of July, we had 535 listings on the market, which is a new high for us over the last year. So you can see prior to that, August of last year, we were at 484. So we're up. And compared to June, we were at 483 at 535. So we now have the most number of houses on the market in Prescott than we've had in over a year. So what that means is if you're a buyer, you've got the biggest selection than you've had in the last year. So take advantage of that if you're buying. Let's also look at what's sold. So sold, we had 126 sales that happened last month. And the month prior, we had 157. So we are down a little bit, actually, surprisingly, from January to July. Looking at the prices of homes here in Prescott, last month for July, the median. So when we talk about median, we're looking at the big swath of all the sales and what was the number in the middle. We like to look at medians because if you take an average, you might have a couple $1 million sales, and that doesn't represent the market as a whole here in Prescott. We do have $1 million houses that sell, but that's not, that's not the normal price point for our area. So we go by median. Anyways, if you didn't know that, now you know. Median sales price for last month was $620,000, and in the month prior was $587,000. So we are seeing the median sales price go up month over month here in Prescott. Sold to list ratio is another thing that we like to look at and we like to watch. Last month it was at, sale to list price. So what the house actually sold for versus what the MLS or what Realtor.com said that the last sales price, the advertised sales price was on it, and they're getting 98.2%. So that's telling me that on average right now, buyers are getting about a 1.8% discount off of the last advertised price that it was for sale. Days on market has dropped significantly. In June, we were at 50 days on market. So we were looking at almost 2 months, about a month and a half on market. And the numbers as of July, 38 days on market. So houses are starting to sell quicker, which is pretty interesting, being that we have inventory up, but houses are selling a bit quicker. The average sales price is up, and you're seeing what the sold to list price ratio is here. Sales are down, but the average list price is up. All in all, what you need to know, one thing that we look at is called absorption rate, or what the months of supply is in homes. And this is how we figure out if we're in a seller's market or in a buyer's market. According to the data, we are at 4.3 months of inventory. Anything under or less than 5 months of inventory, by definition, is a seller's market. Anything 5 to 7 months of inventory is going to be considered a balanced market. Anything above 7 months of inventory is going to be considered a buyer's market, right? So according to 4.3 months, we should be in a seller's market. With the way the market's been and what we're seeing, this isn't true over every price point in the market. With the average or the median price point being 620, I would say anything under 600,000 is probably going to be reflective of us being in a seller's market still. 600 to about 800,000 is going to be a pretty balanced market. And then, inventory over 900,000 or over $1 million is going to be a buyer's market. So that is your wrap on the Prescott stats. Let's dive into Prescott Valley stats now. So Prescott Valley last month, there were 71 homes that sold. And there were 215 that hit the market. So, or 215 active listings on market. I'm sorry. New listings on market was 119. So we did have a surplus of homes coming on market last month, which drove the inventory up. But Prescott Valley is still not seeing the number of the amount of inventory or homes for sale on market that we've seen in the past year. Over the past year, the max was 303, and that was last September. So we are still not even 215. Yeah, we're not anywhere close to 300 yet. So with that being said, let's look at the pricing. So the sold median sales price in Prescott Valley last month was $443,000, which was surprisingly down from June of $469,000. So don't know what the anomaly is there, but yeah, prices went down. There's a number of factors. It would only be a guess of why it went down so much. But let's look at the sold to list ratio. So if you're buying or if you're selling, how much you're actually going to get for the property. Sale to list price ratio was at 98.5. So again, about a 1.5% discount on average off of the listed price or the for sale price online. Days on market dropped significantly. In June, we were at 50 and now at 31.9 days on market. So what that means is the average time a house takes from when it goes on the market for sale to when it goes under contract. So just so you know what that means. Yeah, absorption rate though. So if we're looking at that stat, we always like to look at as realtors and lenders, 2.51 months of supply, which tells me that we are still in a housing shortage in Prescott Valley, even though inventory went up over June. We're still in a housing shortage, which tells me that it's still a bit of a seller's market over there in Prescott Valley. Now let's dive into. Go ahead, Tyler.
I was going to say, I think those lower prices are probably like the prices dropping a little bit is just to show the competitiveness in that market with the few extra listings. And maybe seller, I don't know about you, but it kind of sounds like maybe some sellers out there undercutting themselves a little bit to get their homes sold a little bit faster, offering more concessions, whatever it may be, just to get them off the market faster, which is keeping everything pretty balanced, even though it's a seller market. Like that's what it seems like to me. But
yeah, I'd agree with you on that. Again, with the way the market is, interest rates are, and we'll dive into interest rates here in a minute. It's just making it different. Even though the data says we're in a seller's market, it doesn't feel like that on the ground. It doesn't really necessarily feel like that when we're writing offers or negotiating offers, unless it is a move-in ready house that's priced at or below market value. Then they're seeing multiple offer situations with those homes. But for the majority of homes being sold out there, we're not seeing that, which that would be a true sign of it being a seller's market, is how it was a year and a half ago when there was multiple offers on every single property that went up for sale, unless it was a full rehab project, or significantly overpriced. We had some people out there that were just dreaming on what they were going to sell it for, right? They're significantly pricing it over market value.
Yeah, I mean, it's like me. If I listed my house, I'd want the moon in back because it's my domicile. It's where I'm at, right? But totally get it.
Yep. All right, let's dive into the Chino Valley market stats. So as of last month, there was 31 homes that sold. We had 45 new homes hit the market, so just a few more hit the market than what actually sold, which bumped inventory up to 77 homes on market, which is still way low for Chino Valley. I mean, look, in the last year, last September, we were at 113 houses on market. Right now, we are at 77. And an accurate reflection of this is over in the list price and the sales price. Look at this. The sold median sales price is up to $440 right now, just slightly down from the month prior of June, but you can see overall it's trending upwards. And this is a pretty good reflection of having a lack of inventory and not having enough homes on market for the buyers that want to buy them. Sold to list price ratio. So they're getting 96.3. Oh, that's original list price. Sorry. 98.3% of what the last advertised price for sale was on the home is what it's actually selling for. So right in line with Prescott and Prescott Valley, you're looking at just over a 1% discount on average from the list price. Days on market down to 40.9 average days on market in July, which is down from 66 in June. So we're seeing a trend across all three markets here, Prescott, Chino, and Prescott Valley, of days on market decreasing, which is a good sign. That's a good sign for sellers. And then for buyers, you need to know this data because you need to know how quick a house is going to sell. Don't sit around for a month. Another thing too I'm going to dive into with Tyler and we're going to talk about is getting pre-approved before you start looking at homes, because with the days on market going down, your odds of somebody else snatching it up before you get pre-approved, if you've already seen it, is a lot higher. Yeah. So that's our market stats for Prescott Valley and Chino Valley. Tyler, you want to dive into mortgage news and what's kind of going on in that space?
Yeah, sure. I'd be happy to. I'm sure it's kind of the elephant in the room, right? What are rates? What are they going to do? Where's your crystal ball? That's the big question that every lender gets asked, and anybody that's looking at the market rates. Rates are high today, if you will, right? We have a national average of like 7%, low sevens. So you're going to see a lot of volatility in the market. We're used to watching interest rates and the market and things on our side over the last couple decades, monthly or quarterly, and watching the news outlets and things like that. With how quickly we get data now and how gray the market is with what the Fed's doing, we can't really predict right off the bat what's going to happen every week, right? So we are monitoring things weekly. Volatility is extremely high. We could be in the sevens one week, in the sixes the next week. It's just changing so fast and frequent that there's not one thing or crystal ball that anybody, if you have somebody telling you rates are going to come down next month, I would tell you don't listen to them. We don't know if that's going to happen. There's no evidence, like hard, solid evidence in history that shows that is going to happen. Could it happen? Yeah, sure. They could get lucky and tell you that the crystal ball is going to change and, the market's all of a sudden going to dip down and homes are going to flood into the market and rates are going to drop. But is that likely? Probably not, right? So let's get back to the 30-year fix though. So if you're looking at a conventional interest rate, 30-year fix on a national average, it's going to be around 7% without any discount points. And if you don't know what that is, call me. It's another conversation. But essentially, it's prepaid interest to buy your rate down. And if you were to do that, you could potentially get into the 5% pretty easily if you have seller concessions and other things where you can leverage the current market for the price point that you're looking at. Now, if you're in a market with $300,000 homes and there's 40 other buyers looking for that exact same property in that area you want, you're probably not going to get as much concessions, if any, versus, hey, I'm looking for that $600,000, $700,000 home in an area maybe not everybody wants, or there's not as much competition because of the price point. And you can ask the seller to pay some of that and get you into that better price range and make it more affordable for you to obtain those homes. And then, of course, if you're looking at FHA is a great way to make it more affordable for you today with lower interest rates, lower mortgage insurance premiums. Everybody says PMI, right? You hear that term, MI, PMI. Nobody likes that. No, even we don't like it as lenders. We don't want to put that on you, but it is how we can do it. So that way you don't have to come in with those large down payments, 20% down, 25% down, to be able to purchase a home. You can put as little as 3.5% down with an FHA loan and still make it affordable. And in the last year, FHA has actually reduced how much they will charge for mortgage insurance, which is a great benefit to borrowers. We needed that, for affordability in a whole. And I think that also played a big part in why we saw kind of that influx in those numbers you were talking about earlier, Brent, of, homes going off of the market a little bit faster last month than the month prior, because it takes a little while for people to hear these things. We got that update on FHA mortgage insurance months ago, beginning of the year type stuff. And now it's starting to trickle down that, hey, it is a little bit more affordable to get that if I do these things. I ask the seller to pay some of my closing costs or buy down my rate, or, I use an FHA loan instead of a conventional loan to help with that monthly payment to get me qualified, because they have a little bit more lax terms for qualifications and eligibility. So if you can take advantage of some of those programs, or even just, government-backed loans like FHA and VA, affordability can be possible. Is it there for everybody? No. And that's just the world we live in with inflation, right? So, but hopefully that's a good take on today's rates. If anybody has any questions about today's rates, just reach out to me and I can get in some specifics. But I don't ever want to quote a rate over the air like this, right? I don't think that would benefit anybody. So,
no, well, because it's unique to the individual based on a myriad of different factors. So just because it says the average rate today is that doesn't mean that's going to be your rate. Your rate could actually be a little lower or a little higher. So
exactly. And as a mortgage broker, I work with over 84 different lenders, and we can shop that rate. So there's lenders out there that might have an appetite for that same scenario at a lower interest rate. And, we can work things out to where it's not going to cost as much, or, we shop that for you as a broker. And that's one of the benefits of working with an independent mortgage broker versus going to your bank and they offer you their rate and that's it.
Before we wrap up our show, let's dive into a couple national headlines for news and kind of talk about how they apply to everybody here in the Prescott area. So if mortgage rates fall to 5%, the housing market could get interesting. Could, I don't think is the right word. Will, I think is the more accurate word. What do you think, Tyler? If we get rates down to 5%, is it going to get interesting?
Oh, yeah, definitely. I think 5% is a sweet spot. It'll help with affordability tremendously. Now, if rates drop down to 5%, I think what you got to remember is, why did they drop? 9 times out of 10, there's probably going to be some economic factor that caused that, right? So bad news in the economy is typically good news for mortgage rates and things like that, because it's showing, people can't afford these 7%. They can't afford a 6%. We're dropping that down to 5 because inflation went the exact opposite direction. Now we have layoffs or something's going on to create that, right? So not everybody will be able to take advantage of that. You might be the one involved in that layoff. You might be the one involved in that, stock that came down, and now all that money you had for your down payment and your stocks is gone, right? So there's a lot of factors that can give and take. So it's always a good time to buy if you have the means. But if 5% happens, I can tell you a lot of those people that have been just waiting on the sidelines, that have prepared themselves, are going to come out of the woodworks, and they are all going to want a piece of that pie. And they'll jump on any opportunity. So,
yeah, I agree with you on that 100%. I mean, you're looking, if rates get to 5%, you're going to have a lot of buyers who are currently in a house that might be somewhere around 5%, maybe a little less interest rate. They can then justify jumping from a 3.5% rate to a 5% rate, where right now, I know people that are at a 3.5% rate, and they can't mentally justify going to a 7% rate when they have a 3.5% interest rate right now. So they feel almost like trapped or locked into their current house because of how affordable it is for them compared to what it would be if they bought that same house at 7%.
Yeah, 100%. And all of the cash buyers right now, why do you think they would want to use their cash, right? Because rates are high. They don't want to put their money in that when they could put it somewhere else and, make some money if rates are low. So as soon as those come down, now you're not competing with just Joe and Mary down the road, or, San Martin up in Prescott looking to buy a house. You're looking to compete with, investors that have capital, that are like, hey, I don't need to use my capital anymore because now my cash flow is back. I can make money. I can make more money by utilizing a lower interest rate loan. So the buyer pools start to get really big when rates come down. And that's why we had 2021 and 2022, or 2020 and 2021 with COVID when rates were so low. The investor pool was huge. We had people coming out of everywhere to get a loan, and everybody was competing, and you had to throw $100,000 over, whatever it may be, to get a good, decent house, because that was just the market. And you could go right back into that if all of our buyer pools just grow back to that same size. 3%'s, that's a low rate. 2% was really low rate. So we ever see that coming back to that? It could, but is it likely? Not really.
No.
So, and that's where it comes down to, is 5% going to be the new great rate? Probably. It's a lot better than 7%. I can tell you that.
Well, yeah, and with more buyers entering the market at 5%, that's when, like I was saying earlier, we're going to have more bidding wars that get very interesting, like it did in 2021, and home prices are just going to escalate from there. So, this is not financial advice. I'm not a financial advisor, and neither is Tyler. But one thing we can tell you as real estate professionals, if you buy a house at today's prices with a 7% interest rate, and rates fall to 5%, there's one thing you can change, and that's your rate, because you can refinance with Tyler to get a lower interest rate, but your principal amount will stay the same. Versus if you sit on the couch and you wait to buy, rates go down to 5%, but now that house that you were going to buy is $100,000 more. That price increase has just offset the savings in rate, and now you're financing more home. You've got a higher principal amount than you would if you bought today and then refinanced to 5%, if that ever happened, which we don't have a crystal ball. We're not advisors. We can't tell you when or if it's going to happen, but if it does happen, then you can always refinance.
So the best time to buy is now.
Whenever
if that's good for your situation.
Whenever you're financially stable enough to buy a home, the market does not dictate why you buy a home or when you buy a home. What dictates that is your financial stability. How confident are you in your income? How confident are you in your assets? How confident are you in your credit? Those are the three things, especially if you're getting a loan, you have to have, right? So, but definitely if you can do those things right now, it's a good time, because later down the road, you're just going to be shaving off. It's going to go the opposite direction versus going up, right?
Correct.
Well, buying a house is kind of like that old, proverb. I don't know where it came from, but it says, when the best time to plant a tree was or is?
Yesterday.
10 years ago?
When's the best time to buy a house? 10 years ago.
10 years ago.
So, I literally, because 10 years ago was 2013, and the bottom of the market, bottom of prices was actually 2012.
Yeah.
But that's one of the things in real estate. It's how it goes. When's the best time to buy a house? 10 years ago. So why are you waiting?
Hindsight is always 2020. I mean, could go on and on, right? So I do think if anybody wants a good takeaway about how to do those numbers, if you're a numbers person, look up or Google amortization calculator. That's AMORTIZATION. And you can literally plug in the loan amount, your interest rate in a 30-year term, calculate that, and then change the number to $50,000 or $100,000 more. If rates came down, that's probably what you're going to see, right, in the market. And just look at the difference in the monthly payment. Even when you put a 5% or a 7% rate, hundreds of dollars different. And or even if they're the same payment, like now that rates are down to 5%, you could refinance that, like you said, Brent, and that's going to save you that couple $100. And all it took you was a couple $100 over the next 1, maybe 2 years for that rate to drop, if that's how long it takes, right? So the cost of doing it now is extremely low if you can afford it.
Yep. And that leads into our next headline, which is why so many Americans feel trapped in their homes by their low rate mortgages. So we just kind of talked about this. I was saying that, those buyers those people that I know that are in the 3 to 4% mortgage range right now with their current mortgages, they feel trapped, or they don't want to move because they don't want to get rid of that mortgage and have their house payment significantly increase because they're getting a bigger house. Or in some instances, people who want to downsize to a smaller house or a house that is less in value, or that is a cheaper house. I wouldn't necessarily cheaper by like the amenities, but say a smaller house, they want to downsize, right?
Yeah.
So a house at a lower price point, but with a higher interest rate, they get the same payment that they currently have in their bigger home. So those are the people that are feeling trapped, in their homes. So
yeah, and for those people, and it's not everybody's appetite, right? But for those people, what I always recommend is, what if you rented your current house out? There's a need for rentals. There is a absolute need for that right now. And instead of giving that to institutionalized investors to do, why don't you take advantage of that market and use your low interest rate like an investor would, and they are currently, and maybe take some profits from that to offset the new payment until later on down the road you want to sell that property and get rid of it, and profit from it or whatever it may be. But in the meantime, utilize your equity. There's home equity lines of credit to where you don't have to change your current rate. There's very creative ways you can access the equity without, giving up what you currently have. So, there's some very creative ways you can do that and structure these moves. And you can do that now, or you can, wait until the rates change and try it when everybody else is going to be in there, in the market again. So it all comes down to why you're moving, and do you want to do it now, or do you have the appetite to hold on to this asset that you have for a little bit longer and maybe help you with that transition and the cost to transition, right? So just all in the eye of the beholder. But I tell everybody, get a little bit more creative in these markets, because high interest rates aren't the only thing you have to think about. You need to start flipping that into, all right, well, I own this. This is mine. I'm stuck in this, but it's a good stuck. Would you rather be, stuck in a 7% and rates went up to, 110, right? Like you don't want your 18%. You don't want any of that. So you're in a very good spot to be able to take advantage of that and even move into a new home and have some of those costs taken over. So.
Yeah, when they interviewed this couple in this article, he said he'd be more likely to move if rates came down to the 4 to 5% range.
And then what's he going to deal with, right, Brent?
Super interesting. Yeah, then he'll sell his house for a lot of money, right? But then he's going to have a harder time trying to buy another house. Mm-hmm. And the price on that house is going to be more than it is now. So here's a perfect example of somebody, that they interviewed that felt that way about it.
Exactly.
So, super interesting. Well, that concludes our market update, for this month, for August. So going over July stats, going over what happened in the mortgage space, going over some headlines. If you have any questions and you're watching this video not live, be sure to get a hold of us at our contact information that's been scrolling on the screen. And shout out to Mr. San Martin Rodriguez from the Prescott Times. Thank you so much for giving us the opportunity to be here today to spread the knowledge. Any final questions? We don't got you. No audio on your end.
I said, thank you for all of your guys' special education, because without it, a lot of people were just sitting there not knowing how to go ahead and go about it. And I'd be one of those guys. But needless to say, great information. I think that having it from two sides of the spectrum, one being down south and one being up here in north. And Brent, I know that you work all over the state of Arizona, and you're hyper-focused on Prescott in general. And also, I think it's Yuma. But anyways, if you guys want to go ahead and get a hold of these two guys, the information has been scrolling on the bottom of this screen right down here. And if you guys want any more information, please feel free to break out and call them and get a hold of them. They're really amazing guys to talk with. They're open book, and not to mention, they got some answers. Well, I appreciate you guys 100%, and I thank you so very much. Thank you.